Welcome back to The Explainer, everyone. We are unpacking a truly historic week in the markets today for the week ending August 10th, 2026. Seriously, what a week. We saw the S&P 500 not just climb, but smash into an all-time record of 7,757. At the exact same time, the U.S. economy shocked us with an outright loss of jobs, and Uber crossed a massive, history-making $10 million cash flow milestone. We've got a ton of ground to cover today, and honestly, the dynamics at play right now are absolutely fascinating.
So here is our playbook for today. First up, we're diving into the jobs shock paradox. 2, how crypto is rebuilding the system. 3, we'll do a deep dive into TSM and Uber. And finally, number 4, we'll look at the week ahead and where we're finding alpha.
All right, let's jump right into section 1. The jobs shock paradox, why bad economic news equaled a historic market rally. Let's kick things off with this beautifully massive number, 7,757.64. That right there is the S&P 500's brand new all-time record close. It capped off its best week since April, adding nearly 3.4% in just a single week, which pushes the year-to-date return to about 12.7%. And the Nasdaq wasn't left behind either. It surged 5.2%, and semiconductors absolutely roared back to life with a 7% weekly gain. But guys, here is the real shocker. While stocks were hitting these all-time highs, the U.S. economy actually lost 23,000 non-farm payroll jobs in July. Now, this was the first outright negative print we've seen in this cycle. It missed the consensus estimate, which was looking for a positive 83,000 to 95,000 jobs by over 100,000. And if that wasn't crazy enough, previous months were revised down by a combined 103,000 jobs, all while wage growth slowed to its lowest point since May of 2021. So naturally, this raises a really fascinating core question. Why in the world would investors cheer when the economy is actively shedding jobs and the labor force participation rate is dropping back down to pre-COVID lows? I mean, on the surface, it makes absolutely zero sense, right? Well, the translation here is all about Federal Reserve policy. You see, bad economic data right now basically acts as a permission slip for Fed Chair Warshchair to pause rate hikes in September. When the market saw those jobs just vanish, the probability of a September rate hike plummeted from 55% down to 42%. And that shift in expectations, it drove the 10-year Treasury yield down to 4.64%, which completely lifted the ceiling off the market and sent equities soaring. In today's upside-down world, bad news for the economy became the ultimate good news for stocks. Moving on to Section 2. Crypto rebuilds the system. The financial plumbing is moving on-chain. Because while traditional equity markets were hyper-focused on that jobs shock, the crypto sector was quietly and aggressively rebuilding the global financial system right under our noses. Institutional adoption is just accelerating everywhere you look. Over in the UK, Coinbase is blurring the lines between crypto and traditional brokerages, allowing users to trade 4,000 US stocks 24/5 right next to their crypto bags. In Russia, a new law formalizes regulated crypto markets by September 1st, explicitly allowing it for cross-border settlements. Meanwhile, you've got BlackRock bringing traditional finance on-chain by tokenizing real European money market funds using JP Morgan's Connexus blockchain infrastructure. And back in the US, even though the Clarity Act got delayed by the Senate to September 14th because of banking industry concerns, a cloture motion was actually filed. That means they've essentially forced a path to a highly likely vote as soon as they get back. I love how our source puts it, quote, "Finance is moving on-chain. If you understand the plumbing early, you understand where the money is going before everybody else notices the pipes changed." That is exactly it. Regardless of the U.S. Senate delaying the Clarity Act, the actual infrastructure of traditional finance is already migrating to the blockchain. From Coinbase competing for your entire investment wallet to BlackRock validating JP Morgan's settlement rails with real client money, the financial plumbing is literally being rewritten right now. And this just brilliantly illustrates how our macro thesis from earlier is colliding with the crypto world. When the jobs shock completely removed those near-term rate hike fears, the opportunity cost of holding non-yielding assets dropped significantly. And in response, Bitcoin surged right past the $65,000 resistance level, and Ethereum climbed back toward its $2,000 recovery target. It turns out, a September Fed pause might just be the most bullish macro alignment for digital assets we've seen all year. Okay, let's head into Section 3. TSM and Uber deep dive, validating the core thesis with hard numbers. Let's ground some of these big macro and crypto ideas in some specific company realities. It was a massive week for earnings.
We gave TSM an A grade this week, and honestly, they earned it, perfectly executing right within our called entry zone. We highlighted that 395 to 415 zone, and the stock just climbed right through it, ultimately hitting 420. With 19 different analysts reading it a strong buy and slapping a $540 average price target on it, TSM's AI chip manufacturing monopoly thesis remains flawlessly intact as they gear up for their 2-nanometer commercial debut. Now, shifting over to Uber, we got a really mixed Q2 earnings reaction, which is honestly a fascinating study in market psychology. The market initially dropped the stock 5% because of this tiny $80 million miss on their Q3 guidance. But guys, when you realize that miss is on a massive $59 billion base, it is literally a rounding error. The incredibly bullish reality here is that Uber now has 208 million active users, their gross bookings grew by 24%, and, perhaps most importantly, their autonomous vehicles are now live in 7 cities, with plans to expand to 15 by the end of the year. To really put Uber's transformation into perspective, you just have to look at their historical trajectory. Remember before 2022, they were burning billions of dollars just trying to scale. And now, they just crossed $10 billion in trailing 12-month free cash flow for the very first time ever. They have officially, undeniably completed their pivot from a money-burning startup into an absolute cash-generating machine. We also definitely want to flag a major tactical win related to Uber this week. By using some responsible, defined risk leverage, a pre-earnings options trade, specifically those August 21st $72.50 calls, were bought at $2.10 and sold at $3.40. That delivered a sweet 61.9% gain on the position, capturing the premium before that weird post-earnings dip and contributing 1.86% to the total portfolio return. It's just a perfect example of how you can use precision tools around really volatile earnings events to limit your risk while still capturing the upside. All right, rounding it out with Section 4, the week ahead and alpha, your tactical calendar and portfolio tracker. Wrapping up our analysis for the day, let's check the scoreboard and give you the tactical cheat codes you're going to need for the heavily data-driven week ahead. The calendar is packed, and positioning is literally everything right now. The overall portfolio is sitting pretty at an estimated 22% year-to-date return. That is generating 9.3% alpha over the S&P 500's 12.7% return, which is fantastic. This outperformance is really being driven by our defensive income positions and those strategic oil holdings in XLE and DVN. Yes, oil did pull back 3.4% on those Iran ceasefire rumors, but we are holding those names as structural insurance. And notably, we are sitting on a very comfortable 30% cash allocation in money market funds, keeping our dry powder totally ready to deploy depending on how this week's data shakes out. So, here is your critical calendar for the week. First up, an urgent alert. You must own Clorox by Tuesday's close if you want to snag that $1.24 dividend. But the absolute main event of the entire week hits Wednesday morning at 8:30 a.m. Eastern with the July CPI inflation report. We'll follow that up on Thursday with the producer price index data and jobless claims, and then Friday closes us out with retail sales to confirm if consumers are actually still spending their money despite the weak job market. And I want to leave you with this final thought to chew on this week. If Wednesday's inflation data falls alongside those lost jobs we saw on Friday, well, the Fed just got their golden ticket to pause. It is basically the ultimate soft landing scenario. But if inflation unexpectedly rises because of recent oil price effects, Chair Warsh faces the ultimate dilemma, having to choose between fighting sticky inflation or saving a rapidly weakening labor market. So what do you think the numbers are going to reveal? Thanks so much for joining me on this explainer. Stay tactical out there, and I'll see you all next time.